What's up, guys? Back with another video, and let me go ahead and start off saying we're going to learn about banks. Now, you're probably saying, well, if we're learning about banks, is this something that I really need to listen to? You don't have to really listen to it, but if you want to understand the banking industry and how banks work, let's go ahead and take a dive. So, banks' balance sheets, as we know, balance sheets has assets, liabilities, owner's equity, but let's go on a little further. Bank's balance sheet lists the sources of a bank's funds, liabilities slash deposits, and uses to which they are put to. So the use of which banks put things to are the assets. So investing liabilities into assets to create value for capital providers. That's what banks do. They invest their liabilities into the assets to create value for the capital providers. So what are the assets for a bank? Well, let me just tell you guys, if you're thinking about what's the asset and what's the liability to anything, bank, it will be very, very different than what you think for banks. So bank assets, they're securities, so the things that they own, such as stocks, etc. The loans, cash and reserves, and the other assets. So you're saying, well, how are loans an asset for a bank? Isn't that a liability? It might be a liability in a way that you see it as a loan. You're handing out money and you're saying, well, if this person doesn't pay it back. But think about it. When banks loan out money, that means that somebody else has to pay them back. And they know they'll pay them back, otherwise it's going on a collections credit report. So when you hand out money to somebody, it's in your favor, not their favor, because they're asking for the money. So in turn, once they charge an interest rate, they're making money on top of the money they loaned out. So that is an asset to the bank. Cash and reserves, obviously no, cash is king, so therefore it's an asset, and other assets as well. Bank capital, checkable deposits, borrowings, and non-transaction deposits are liabilities. So let's dive a little bit further into what are these things that are liabilities. So checkable deposits are accounts that allow the owner, which is the depositor, so your checking account, basically, to write third-party checks. So you're saying, how is that not an asset? How is it a liability? Because look, when you put your money into the bank is responsible. Obviously, you're responsible for your money too, but the bank is responsible for holding your money. That is why if you put it maybe in a savings account or something, or you put it inside the bank, you incur a dividend or interest on that a little bit, but that savings account obviously is not a checking account. But the thing is, because you put your money into a bank, the bank is responsible for that money because you opened a bank account with them. Therefore, if the bank goes insolvent, FDIC insurance, $250,000, they are responsible for making sure that your money is kept in a good manner. So checkable deposits, obviously it's your checking account, things how you gotta write the third-party checks. It's non-interest owning account. So as I say, checking account, you don't accrue any interest, you don't have a dividend. My credit union, we have a dividend from the savings account, but non-interest accruing accounts. And it says it makes up about 10% of the bank liabilities, 10%, because everybody needs to put their money somewhere in a checking account. Obviously, people are not going to just say, oh, cash a check, hold on to my money. Some people might do that, but most people just say, put it on the bank account, put it on the card. And it says it's the lowest cost of funds for the bank, so therefore it's safe and liquid, but it's high risk to the bank, because what happens if somebody withdraws all their money? What happens if the bank goes insolvent? So checkable deposits is the lowest cost of funds, but it's safe and liquid, yes, but it's also high risk. So that's why checkable deposits are a liability to the bank, because anything can happen to that checkable deposit. Borrowings obviously are a liability because you're borrowing money. Bank capital, you got to raise the capital up for a bank. It's a liability. You got to learn how to put your own money in. Non-transaction deposits, you're saying, how is that a liability? So it makes up 50% of the bank liabilities. Primary source of bank liabilities, because it's 50%, are accounts from which the depositor cannot write checks. So the opposite of checkable deposits. So basically, your savings account, certificates of deposit, and it's the highest cost of funding, but it's most stable for the bank. Because when people put their money in savings, they don't expect to really withdraw it unless they need to. Checking accounts, everybody's withdrawing. So that money just going. But non-transaction, that's what it says, non-transaction. So it's just sitting there. So it's stable for the bank. but it's the highest cost of funding because you got to keep it revolving, going around. So it's the primary source of bank liabilities because, like I said, everybody wants to save money. Everybody wants to store money. So they said we can't put in a checking account because that's where I have to pay from. But when they put in a savings account, it just sits there. It incurs a lot, highest cost of funding. So they have, the bank obviously pays the interest rate back, but that's why checkable deposits are non-interest owning accounts or interest accruing accounts, because those things are money or accounts that money comes out of that revolves and revolves, if you understand what I'm saying. Money's constantly being taken out of a checking account. So nobody's going to say, oh, my savings account is cool. No money's out of that. Checking account, use a savings account. That doesn't make any sense. So in total, to make it simple, bank liabilities of the checkable accounts and non-transaction accounts is because A, you either got to fund it, or B, money keeps revolving out of it. So let's talk about borrowings now. Another liability, borrowings. Funds from the Fed. So you obviously have your Fed funds rate, and then you have your, I believe the other one is the discount rate. So your Fed's funds rate is the rate that banks charge each other for overnight loans. Say a bank needs some money, so they're gonna get some from another bank. Fed funds rate is when they borrow from another bank. Discount rate is when you borrow from the Federal Reserve itself. So that's that, but I'm not gonna get into that too much. I want to keep it on track. I want to be on topic. Funds from the Fed, when you borrow, that's a borrowing because you're borrowing from the federal government. So therefore, when you borrow from the federal government, you got to pay it back. That's liability onto you because then I have to pay money back. Just as a loan is an asset because you have to pay it back to them. They don't got to pay it back to you. Other banks and corporations, so like I said, you borrow from another bank, Fed's funds rate. Commercial paper, which is unsecured short-term debt that is pretty much issued for funding of payroll, inventories, accounts receivable, etc., issued by corporations. So if they have to borrow commercial paper, then that is a borrowing from them. Discount loans, etc. So you have a loan on discount, you're not really getting any money from it, so therefore a bank will have to make that money back. So it's a liability to them. However, all of these are more volatile than other liabilities, but they make up 1%, just 1% of bank liabilities, just 1%. So more volatile, bank doesn't want a lot of volatility, so they're gonna make up 1% of that. Another thing, bank capital, source of funds supplied by bank's owners. So you're saying, well, how is bank capital really a liability? So look at it this way. You're investing in a company. You're putting forth your money to that company to say they're going to be profitable. They're going to make me a return on my investment. But that is a risk because people are putting money into you. So you're saying, okay, the company's not doing well. I'm withdrawing my money. Therefore, same thing happens to bank. The bank's owners say we're putting money into you to be a great bank. If you're not doing great, we're going to pull it, you go and solve it, and that's it. So you're taking a risk on other people's money. Therefore, that's your liability. Reserves are funds held in account with the Fed. That's why they are an asset because you have money on the back end. And then cash items in process of collection. So those are checks deposited at a bank, funds from other banks' account haven't been transferred. So what am I saying? So if the money isn't available instantly, it has to be processed. So let's say that you deposit something at a bank, but it's not there yet. Think about it as when you make a purchase and you look on your bank statement, right? Like right then, and you say, okay, I see the money has come out, like it's came out, but I don't see it actually coming out yet, as in it has not happened. You may have to wait a day for it to process, for it to clear. So it's in the process of being collected. So think about when you deposit a check. You may not see it right then if you're doing a mobile deposit, etc., but it will come through. But the money is there, but it's not fully there, processing. So cash items in process of collection, that's what that is. Deposits at other banks are usually deposits from small banks at larger banks, which is correspondent banking. Securities are obviously U.S. government agency debt, so non-equity. Securities, municipal debt, short-term treasury debt is a secondary reserve due to high liquidity for banks. And obviously, these are assets I'm talking about. The loans, banks' income earning assets, about 53% of the assets. So like I said, why do banks make a lot off of loans? Because you owe them the money whenever you take out a loan. Banks lend you money, they make money on top of money because of the interest. Therefore, that's why it is an asset to them. So I kept this video kind of short. Just wanted to let you guys understand how banking works. I'm going to make a part 2 of this. So guys, thank you. Please tune in for the next video.